Introduction. If you've decided to build your investment strategy around a single globally diversified set-it-and-forget-it equity ETF, you've already won half the battle. You've embraced the beautiful philosophy of the lazy investor, which, despite the name, is statistically one of the most profitable ways to build wealth over time. But once you commit to buying the entire global stock market, you immediately run into a classic financial dilemma. Do you choose the iShares MSCI ACWI UCITS ETF? Or do you go with the cult favorite, the Vanguard FTSE All-World UCITS ETF? Both of these funds are the accumulating versions, meaning they automatically reinvest dividends to supercharge your compound interest, and both trade in US dollars as their base currency. On the surface, they look like identical twins. They both promise to capture the global economy, they both hold the exact same trillion-dollar tech titans at the top, and their long-term performance charts look like they were traced right over one another. But if you dig into the actual mechanics, the index methodologies, and the underlying data, you'll find some fascinating differences. We are talking about variations in the sheer number of stocks you own, how certain major economies are categorized, and how much you are paying for the privilege of owning the world. We are going to break down the hard numbers, the structural quirks, and the hidden details of these two giants so you can figure out exactly which one deserves a permanent spot in your portfolio. The battle of the indexes. To understand these ETFs, we have to look past the fund managers BlackRock and Vanguard and look at the actual rulebooks they follow. The iShares ETF tracks the MSCI All-Country World Index, commonly known as the MSCI ACWI. Vanguard, on the other hand, tracks the FTSE All-World Index. Now, both indexes are designed to capture large and mid-cap companies across both developed and emerging markets. Together, they cover roughly 85% to 90% of the investable global equity market. But MSCI and FTSE don't always agree on geography, and their most famous disagreement comes down to one specific country, South Korea. MSCI still classifies South Korea as an emerging market. That means when you buy the iShares ACWI, South Korea sits in the same bucket as China, India, and Brazil. FTSE, however, upgraded South Korea to a developed market quite a while ago. Why does this matter to you? Practically speaking, it doesn't radically shift your daily returns, but it changes how your money is sliced and diced. If an emerging markets crisis hits or if a specific regulatory shift occurs, South Korea's weight behaves differently within these two funds. It's a great example of how owning the world depends entirely on whose map you're using. The numbers game, holdings, and diversification. Let's look at the sheer scale of diversification, because this is where the gap between these two products widens significantly. The Vanguard FTSE All-World Index contains over 4,200 stocks, and the Vanguard ETF itself holds roughly 3,763 stocks in its portfolio. Vanguard achieves this using a method called representative sampling. They buy almost everything that matters to perfectly mirror the index. Compare that to the iShares MSCI ACWI ETF. The underlying MSCI index has around 2,700 components, but the iShares ETF only holds about 1,699 stocks. Hold on a second. If the iShares ETF holds nearly 2,000 fewer stocks than the Vanguard ETF, are you missing out on massive amounts of diversification? The short answer is, not really. iShares uses a highly optimized sampling technique. Because global indexes are market cap weighted, the largest companies carry almost all the weight. The bottom 1,500 tiny mid-cap companies have such a minuscule impact on the index's movement that iShares mathematically filters them out to save on transaction costs, liquidity issues, and trading fees. So, while Vanguard gives you a purer, wider net with over 3,700 companies, iShares gives you a leaner, highly optimized basket of around 1,700 companies. If you love the psychological comfort of maximum diversification, Vanguard wins this round. But if you care about efficiency, iShares' optimized approach gets the exact same job done with half the luggage: sector weights and top holdings. Because both funds are heavily market cap weighted, the top of the pyramid looks incredibly familiar. If we peer into the engine room of both ETFs, the heavy hitters are identical. In both funds, Nvidia sits right at the top, commanding roughly 4.6% to 4.9% of the total fund value. Apple follows closely behind at around 4% to 4.2%, and Microsoft takes the third spot at around 2.9% to 3.1%. Rounding out the top five, you have Amazon at roughly 2.4% to 2.5%, and Alphabet at just over 2%. When you add up the top 10 holdings, which also include giants like Broadcom, Meta, and Taiwan Semiconductor, they make up about 25% of the entire fund. That means 1/4 of your all-world investment is concentrated in just 10 massive tech-driven corporations. When it comes to sector allocations, technology is the undisputed heavyweight champion. For the Vanguard FTSE All-World, tech accounts for roughly 35.2% of the portfolio. For the iShares MSCI ACWI, tech sits closer to 29.1%. A big reason for this apparent 6% gap isn't that Vanguard loves software more than iShares. It's mostly due to how FTSE and MSCI classify specific companies across tech, telecommunications, and consumer discretionary sectors. Financially, your exposure to the digital revolution is massive in both, followed by financials at around 14% and industrials at roughly 10% to 12%. Cost and size, TER and AUM. Now let's talk about what keeps the index investing community up at night: the expenses. When you are holding a fund for 10, 20, or 30 years, every single basis point matters. The Vanguard FTSE All-World UCITS ETF has a total expense ratio, or TER, of 0.19% per year. The iShares MSCI ACWI UCITS ETF has a TER of 0.2% per year, a difference of 0.01%. Mathematically, on a $100,000 portfolio, that is a whopping $10 a year. It is a virtual tie. You shouldn't make your decision based on the management fee alone, because tracking difference, how efficiently the manager actually tracks the index, can easily swallow that microscopic difference. Both BlackRock and Vanguard are absolute masters of institutional trading, so their tracking drag is minimal. They also both engage in securities lending to generate a bit of extra revenue for the fund, which helps offset these structural fees. What about fund size or assets under management? This tells us how liquid the ETF is and how safe it is from being liquidated or merged by the provider. The iShares ACWI ETF is a beast, managing roughly 29.5 billion euros, which translates to over 32 billion US dollars. It's the largest and most popular ETF tracking the MSCI ACWI index in Europe. But Vanguard's FTSE All-World accumulating share class boasts total fund assets of over 46 billion US dollars, with the overall umbrella fund crossing well over 72 billion. Vanguard has built an absolute fortress of liquidity around this specific product. High liquidity means tighter bid-ask spreads when you buy and sell on your brokerage platform, saving you pennies on the dollar every time you transact. Real performance review. Let's talk about real-world performance, because, at the end of the day, we are here to see our money grow. How have these structural differences played out in the markets? If we look back at the historical data, the returns are stunningly correlated. In the banner year of 2024, both ETFs posted massive returns, up roughly 24.6% to 24.8%. In 2025, the market took a breather, but still pushed forward with a solid gain of around 8.2% to 8.3% for both funds. Moving through the first half of 2026, global equities have continued their upward trajectory, with both ETFs up roughly 12% to 14% year-to-date. If you look at a 5-year rolling window, the total return difference between these two funds is usually less than 0.5% total. Why? Because the global macroeconomic forces that move Apple, Microsoft, and Nvidia move both funds equally. The fact that Vanguard holds an extra 2,000 small companies or classifies South Korea differently amounts to minor background noise over the long run. They are structurally bound to give you nearly identical financial outcomes. The final verdict. So we've looked at the rules, analyzed the holdings, compared the costs, and verified the performance. If they are so similar, how do you actually choose between them? It really comes down to a few distinct nuances. First, look at your brokerage platform. Because these ETFs are listed on various exchanges under different tickers, like VWCE or VWRA for Vanguard and ISAC or IUSQ for iShares, your specific broker might offer one of them completely free of purchase commissions or as part of a free monthly savings plan. If your broker charges you $10 to buy Vanguard but lets you buy iShares for free, pick iShares. Saving on transaction fees up front will easily beat the microscopic differences in the fund's internal metrics. Second, consider your philosophical approach to diversification. If you are a purist who wants the comfort of knowing you own over 3,700 companies, including deeper slices of the global economy, Vanguard is your clear winner. If you prefer the idea of an optimized, streamlined portfolio that discards the smallest, least liquid companies to focus on the 1,700 core drivers of global capitalism, then iShares is the elegant choice. The reality is you cannot make a mistake here. Both BlackRock and Vanguard have delivered world-class, low-cost, highly liquid instruments that allow everyday investors to own a piece of global human progress for less than 0.1% a year. Pick the one that fits your broker best, set up your automatic monthly contributions, turn off the financial news, and let compounding do the heavy lifting. Your future self will thank you. Of course, none of this is formal financial advice, just pure data to help you build your wealth. Thanks for listening and happy investing. Don't forget to hit that subscribe button. Drop your thoughts in the comments below on whether you are Team Vanguard or Team iShares, and I will see you in the next video. Good luck.